Welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, all produce high free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks gonna come back? Chinese stocks are exploding. The dragon has awakened in China, and could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth. Hey everybody, welcome to the live stream. Thank you for joining me on a day when Netflix and others are announcing their earnings. I am deep in the Netflix announcement, trying to see if this stock is going to be a good one to put on the buy list or if it's going to stay on the it's too expensive list. I used to be a shareholder of Netflix and I decided to sell the stock at a big gain and have watched the stock go higher. Right now, the stock is trading lower. It tends to do that. Netflix is one of those where I guess investors are really hoping for the absolute best earnings you can imagine. And when they don't come in quite as high as they expected, the stock tends to have a negative impact. But we're going to do our own homework and see where this stock should be priced. But before we jump into a valuation model on Netflix, let me kind of introduce the channel in case there's some new attendees with us. I analyze stocks fundamentally looking at things like revenue growth, free cash flow, profitability, look at balance sheets, and try to assess what is the intrinsic value of a company based on the future forecast of free cash flows as well as profits, and try to determine that. Now, it's ideal to buy a stock when it's really priced low, and I expect it's going to go much higher, which was the case with our friends here at Netflix. I bought them pretty much close to the low that they had a couple years ago. Stock flourished. It was a really nice win for my portfolio. So now that the stock is a little bit, actually a lot higher, not sure we're going to see a giant discount, but it'd be interesting to see how this business is going about growing and becoming bigger and bigger. So we're going to take a look at their earnings report, and then we'll get into a fundamental review and then evaluation on Netflix. If you would like me to review a stock toward the latter part of this stream, be happy to. Just put it in the chat. If you're a member, it comes with your membership. If you're not, just a $5 super chat, and then we are off to the races. We'll take a look at the stock that you want to talk about. So let's get into Netflix. So there was a couple of items that surprised the market. Revenue in Q3 grew 17% in line with their forecast. 17% is good. This is a pretty big company. Their profitability was a little lower than expected. It was expected at 31.5%, but it came in at 28%. So profitability was a little lower than expected. Here is the revenue year-over-year growth, 17% in the quarter. For the fourth quarter, they expect they're going to grow 16.7%. That looks really good. It looks like their net income looks really healthy. It is a little lower than Q2. Free cash flow, last 4 quarters, looks like they're going to be at around $9 billion. I'll use that in my evaluation. The other nice thing about Netflix is they're buying back shares. You see how the share count is going down. Roughly a year ago, they were at 437 million shares outstanding, where they're down to 434. Now, it's good they're reducing shares that are in the market because it makes each remaining shareholder owner of a bigger fraction of the company, but you don't do it when the stock price is really high. Try to wait for the stock price to be low, and then you buy into that low stock price, and then that's when it really works. At least that's what I would do. All right, so we've got really the biggest update is on the information we just looked at. And the update is revenue's good, profitability went down, and it looks like cash flow is good. Going forward, I think they have a fairly good forecast. They're going to keep growing. But now let's kind of take a look at the company. Let's stand back a little bit, look at Netflix high level, and see how desirable this business is. And then we're going to do a valuation. So overall, Netflix is a $527 billion market cap company. The stock's been rewarding investors, although it's been going a little bit sideways for a few months, call it 4 months. Over the 5-year, this doesn't tell the whole story. If you were with me, or I should say, if you were like me and I'm like you bought around this area here because you saw this really good business just really get sold off by the market. I took advantage of that and took the elevator up to a really nice price. I sold, I took a victory lap. All right, cool. And then the stock went higher, which congratulations to those that continue to hold Netflix. I'm good with the gain that I had and thought that the stock had gotten a little too expensive. Its revenues are $41.69 billion, and the PE is pretty high, 52 PE. Considering this is a mid-teens growth company, that seems a little expensive. Forward P of 42, ditto. It's a little expensive. And I just think there's a small discount available, and I'll share my valuation of the company where I think it is, if it's discounted or not. Taking a look at the overall growth rate of the company, that looks really good. It looks good that they have accelerated their growth. They had kind of a slow growth period in 22 and 23. That's what led to the big sell-off in the stock. I think investors in the market thought, well, this company is going to slow its growth rate, really change the valuation, which I could understand that being the issue. But once they started accelerating growth, look out, the stock's really performed. So that looks really good. Cash flow has been a little rough at times. If you see here, they began, once they got of a certain size, they started to really crank out cash. And now they're going to be around $9 billion in free cash flow, which is good. Their margins are good too. They're expanding as they get bigger. They don't have to, create much more content. They just need to get more subscribers. That way there's more people watching the content on Netflix and they can be more profitable. Good stuff. They also do a nice job internationally, by the way. They put out content in a lot of languages. English, Spanish, I'm sure a bunch of languages. I can't even name them all. So profitability looks good, 24.58 over the trailing 12 months. And I think their operating margin, that's right on the button where they came in. So that's where they're at there. Balance sheet's good. No need to worry about balance sheet with these guys. Now, there are some people that are believing that Netflix is too expensive. And some analysts, I should say. Some analysts believe the stock should be priced at $875 per share. Some analysts believe, hey, it could go higher. Consensus is that it is discounted by 6.6%. And I like looking at the consensus revenue forecast and seeing what kind of growth analysts expect out of this stock. And it's expected that they're going to continue to grow double digit. That's nice. It's going to, as the numbers get bigger, it's hard to maintain the same growth rate just because the numbers get bigger. But it looks like if they hit this forecast, that'll be really good. They're going to end up being a $63 billion revenue company. I think their profitability is going to expand nicely. Their free cash flow is going to expand nicely. And that looks really good. Now, the PE looks high. And, the reason I say it looks high is you can buy Meta, and that has a PE, 28 or so. And you can buy Google Alphabet, PE, I think around 30, 28. And you have to pay 46 for Netflix. And in my opinion, Netflix is kind of a one-trick pony. It's a one-tool player, meaning they're really good at streaming. I give them that. They're really good. But what if streaming all of a sudden takes a turn? What if this AI thing ends up really taking a lot of eyeballs away from streamers and it moves to a different category? That'd really hurt Netflix. But our friends like Google Alphabet being the number one competitor, in my opinion, because they have YouTube. YouTube has more streaming going on than it's the streaming leader globally. And it's not Netflix. Netflix is number 2. So I think Google Alphabet's a more diversified business, and it could weather kind of a surprise in their industry, a threat in their industry. So that's just one thing I put out there that I've always thought, Netflix at some point should get a little bigger, get a little more diversified, because pure play could work, but not for a long time. You look at Apple as an example. Apple did not start with the phone business. They started with computers, desktop computers, and then they moved to other devices, including like notebook computers and so forth. And the iPhone really caused the explosion of revenues. And now it's a big category. But they are hitting a growth wall. They can't grow anymore. So those guys, I think Netflix can suffer the same outcome, which is if they see eyeballs go away for another streamer that comes or another shiny object out there that people want to watch, it could really hurt Netflix. Just high level is one of the things I would put out there. All right. So the stock, these are a lot of numbers, but let's get into a process. And let me say hello to Falls Grave. Good to see you. And I appreciate that. Thanks so much. So we're going to fill in a valuation model. And this valuation model already has Netflix in there, but we need to update data based on the fresh data that the market just told us about. Right now, before I update everything, my price target is $7.52.92. So I'm well below the current stock price. But let's update the numbers and see if I was way off on my forecast from a quarter ago, or if I'm in the ballpark or maybe even on target. All right. So I'm going to move the Netflix earnings information over to a monitor you guys can't see. So that way I can look at one monitor and update data on another. All right. So they have been guiding that they're going to do $8.25 billion. Now, companies may guide and kind of give us a lower number so they can beat it, right? So instead of going with the guide, I think I'm going to go with the trailing 12 months and then grow that number, because I think that's appropriate since we have that data now. I think it'd give us a more accurate picture of what's going on with Netflix. They're producing this cash. We want to know, how valuable is this business? The company may be posturing and telling us, oh, we're going to do this amount when they end up doing more. So let's use the actual numbers. So that's our trailing 12 months. These are 4 quarters that they put in their earnings release, and I'm going to grow it by 10%. Okay. Now, this is always when you model things, right? And this is how I do it. I think it's appropriate. Is you're always looking forward. You're not looking backwards. Backwards gives us good data, but we always have to think forward. What are the next 12 months going to do? And they're growing, mid-digit. They're expanding their profit. I like that. And I'm going to grow overall their growth rate on their cash flows by 15%. I'm going to use a discount rate of 7.5. Probably a month ago, I was at a discount rate of 8%, but I'm moving it down because we're going to go into a lower interest rate environment, making equities more valuable because the mathematics just work out that way. All right. So next, we're going to update our cash. And Netflix, I do like that they give us lots of information. I kind of do not like when companies have an earnings and they just give you a little bit. It's like, come on, guys. You got to communicate to the owners of the business. You got to give them all the good information that you've got. Don't be hiding things. And these guys, they give us everything. So kudos to them. All right. So that's their cash. But I also have to add some short-term investments they've got on their balance sheet, which is about $37 million of short-term investments. It looks like I had a keying error here, so let me correct that. And they've got their debt, long-term debt. Okay, so good. They've paid off some of their debt. Now, these guys are producing cash, so that's not a surprise that they're paying off debt. Very good. All right, so I've given them a better forecast of cash. I think this is accurate. Remember, they're going to grow mid-teens for the revenue. And based on that revenue growth, 15% growth rate on all years 1, 2, 3, 4 into the future, I think is accurate. When I do that, I get a net present value of all those cash flows of 367. I add cash, take away debt. I end up with an equity value for Netflix of 362 billion. The market cap's way above that, 538. And really, we're 33% off the stock price. The stock price is 33% too high on Netflix. All right, let's take a peek at the earnings per share information, and then we'll update this part of my valuation, because I also like to look at earnings per share. Most of the value that I calculate on a stock is based on that free cash flow, 66% of it. But I like to look at earnings per share, because I think it represents a company well when you can look at both profit and free cash flow generation. My number is correct. Now, my PE, again, I can't give them a super high PE because I have alternatives. This is not the only company in communication services that's available. I could buy Meta. I could buy Google Alphabet. I could buy Reddit. I could buy, go down the list. And if those stocks, I can get a PE ratio that's in the high 20s, why am I going to pay more for Netflix? Just wouldn't be rational. So that's what I'm going with. So overall, Netflix is priced 27% too high. And I would not buy Netflix for my portfolio. I think, looking back, I sold Netflix with a big gain, and would have probably continued to look at the stock if I had held it and be a little bit nervous when it started to sell off, like on a day like this. I think I did the right thing for my portfolio, and I'd love to see the stock sell off again and really get discounted, and I'll buy it again and make money on it. But for now, it is a stock that I'm glad I sold. I would sell it again at this price. We'll see how it trades. It's too soon to know, where's Netflix going to go from a stock price? It's down 5.58%. Okay. And the stock, again, it's been performing great. Year to date, 39%. 1 year, 62% higher. So taking a small hit on that type of performance, I don't know that many investors would be all that put off by it. Maybe it's just it's going to settle down a little bit. For all we know, it's going to make back all that loss over the next 24 hours. We'll see. Netflix tends to sell off on earnings, and then it comes back because these stocks that consumers or retail investors can really easily understand tend to be favorites for them. Hey, I know what Netflix does. I'm a customer. I've been a customer for 10, 20 years, and they can get their heads around it. All right. So we are off on the right foot. We just finished Netflix. We got people coming in the stream. Ben 10, it is going great. I hope you're doing well. Thanks for tuning in. And Adobe is up. I am so happy for all those that own Adobe, because a lot of people that tune into this channel are on Adobe. I'm an owner of Adobe, and I've been a little frustrated because Adobe's just been not moving higher, but I hope it keeps going higher. I would love to see a stock that I do believe is discounted. And you know what? I'm going to put Adobe on the list of stocks that I would like to analyze on this stream. It's on the list. I'm going to talk specifically about Adobe, tell you the discount I'm seeing, but I'm also going to be realistic that the market, for some reason, has not liked software companies. I don't know what software companies, how drastic the AI threat is to software companies. I don't believe much, but that's one guy. That's one investor. Falls Grave. You want to look at Lulu. Glad to. Lulu is discounted. I can tell you that much. Now, I'm not an apparel expert. But I could tell you, geez, my wife loves their product, and a lot of ladies love their product. So let's take a look at it and see what's going on with Lulu. And thanks for tuning in. Give me a few minutes. So we've got Lulu on the first position of request and Adobe the second position. That's how I'm going to go about it. What I wanted to do is just check in on some of these earnings, if you guys wouldn't mind. And then we'll come back to Adobe and Lulu. So a couple of other announcements that should be coming out. One of them is Intuitive Surgical. Wow, look at that. Holy smokes. And I've had this stock priced too high. I wonder what's being announced here. 21% rise in after hours. That is a boom. Now, this stock had been selling off. And FYI, I started calling this stock out, so to speak, way back here. So I was like, man, this stock's too expensive. And it started to sell off. So I began to think, okay, maybe I was on the right thread here. But now this thing's up 20%. Holy smokes. What did they do? Did they cure cancer? Let's take a look. Let's take a look at their earnings and see what's going on over at Intuitive Surgical. These guys they create a lot of products, as the name would tell you, for surgeons, hospitals, all these really important devices and machines. Now, let's take a look at their earnings, because there must have been something really, really impressive in here. And then I'll get into my valuation of Intuitive Surgical. So Q3 highlights. So they have this Da Vinci machine, and I think it allows surgeons to do surgeries that are very difficult to do. And I think they can do some remote surgeries, but I'm not an expert on them. I just know it's a machine that surgeons use. And they grew the number of procedures used with the Da Vinci machine by 20%. Okay. They're growing their install of these machines. They repurchase shares. Okay. Looks good. And then 2025 outlook. So they're going to grow 17 to 17.5% in 2025. Okay. That's good. It's not like incredible, but it's good. And here is their revenue breakout. Good increase on revenue is mentioned. So actually on revenue, if you compare September of 24 to September of 25, the growth is more like 20. I'm going to say about 24, 23%, which is very good. So that is a very good number for the quarter. This is for 3 months. If we looked at an annual number, they'd be probably revenue around 10 billion. All right. And this is the 9 months. Balance sheet. Okay. I think they have a good balance sheet. And they didn't give us a statement of cash flows. So they're growing low 20s. They're going to guide to grow 17 to 18% next year. And they've been growing at that rate. Okay. So that looks good. Yeah, it was good earnings. They're growing higher than 20.77. They're probably growing at 23, 24%. If you just look at the third quarter that they're announcing, Their gross margins are not the best. They're good. They're very good, but they have a device where they're a med device company. They have to produce these machines, so it's not cheap. They have to use great materials, have skilled employees manufacturing these machines. So the gross margins are not as high as like other businesses that might have 85% gross margins, but this is a good gross margin number. Their profit margin is good and their free cash flow is good. Now, strategically, this business, Intuitive Surgical, does have a very strong moat. It's kind of one of one, right? They're doing these machines, they get used. Now, they're not the only company that's in this space, but they're a very well recognized company. And should they become dominant, it's a pretty good moat because surgeons will get certified, trained on them on these machines, and then they can do the surgeries. So that's one real positive thing about them. Looking at their forecasts, you've got 15 analysts covering them. Analysts do believe they're discounted by 27%. That looks good. And today they're probably thinking to themselves, see, told you guys, these guys were discounted. The business is going to continue to grow nicely, mid teens, 14 and 26, but they're guiding that they're going to actually grow at 17. So it looks like they raised guidance, and that's why they're rallying up 20%. They beat and raised by a good portion, and looks good. Profitability is going to expand, and their PE ratio is going to remain high. And I would say that, okay, maybe they're worth that PE, but it just brings it into question. It is a little bit high. Can I find an investment that could deliver this type of, financial benefit to me in the form of free cash flows, profits, its moat, its strategic place in its industry, and all that good stuff? And that's, can I get a better investment for a lower PE? I think I can. So let's keep analyzing. Now we've looked at the business. I do recognize that these guys are impressive, but let's take a look at their valuation now. And like I did before, I'm going to move their earnings announcement over to a page you guys can't see. We're going to drop into their valuation, do some homework here. All right. So first, I'm going to change the discount rate because we're going down. Interest rates are going down, right? So that's good. All right. So the trailing 12 months free cash flow plus growth, that's what I've got in here. And they didn't give us a cash flow statement in the earnings announcement. So we're going to have to use the best information that I've got available and go from there. So I've got the information open on another screen here. And so free cash flow is 1994. They're growing at 20%. That's pretty good there. So what I'm going to do is I'm going to bump up the initial year because they did have a really nice year. And I'm going to add 25% to the initial year. I think that's the way we could recognize that, hey, they're doing well this year. Gotta recognize that. Okay, so we've got that in there. And then years 2, 3, 4, even though the revenue isn't going to grow at 20%, it's going to grow less than that. I'm expecting that they're going to have economies of scale. As a business gets bigger, they become more efficient. They can do more with the same stuff they have and the same staff and so forth. So I think that's not overly optimistic. I think it'll be fine. Cash. So they did give us a balance sheet. So let's update our cash position straight out of the balance sheet. All right. So we've got cash went down a tiny bit here. Let's see here. No, it actually went up. Okay. And I don't think they have any debt. Nicely done. Not carrying debt is a sign of strength. Very good. So even after giving them a cash forecast that I think they're going to come in with, it's priced 35% too high. Now let's take a look at earnings per share. Earnings per share. So they're beating and raising. That's good. And it's $9.45 is the consensus. I'm going to go 28. And that growth rate is slight bit optimistic, but since they did beat their earnings, I'm going to stay with it. So I still think Intuitive Surgical is 34% too high. Those are just the numbers. Now, somebody that's more optimistic about the business, maybe they think somehow they're going to grow them, grow cash flow faster. And this is really a tool that I use, and I offer it to members of the channel, but that's where I get. And remember that we have thousands of choices on stocks to choose from. The goal is to pick the right ones at the right time, buy them at a great price, and then see a great return on investment, right? It's not to just find a great business. That is important, but that's kind of easy. Intuitive Surgical is a good business. Okay. Netflix, good business. Google Alphabet. I can go down and give you 100 good businesses. But the trick to it is to buy them at the right time and then see your investment go up in value. I think Intuitive Surgical is just too expensive. It's too high. I started saying that, and since I started saying that a year and a half ago, the stock has been trading lower. So that's that. So, all right. Now we've got Intuitive Surgical in the books. They're having a good night. They're like enjoying a really nice rise. If you own Intuitive Surgical, congratulations. Go out to a nice dinner tonight or something. Treat yourself because you've got the dough. You've got the money because you own Intuitive Surgical stock. All right. So got some more comments coming in. Let's take a look at Ben 10. You were in Paris this weekend. You saw the GSL headquarters. Very cool. So what is GSL? This one here, Global Shipley's headquarters. Maybe I'm not catching the message correctly, but being in Paris sounds like a lot of fun. Awesome city. Been there once and enjoyed it. Really, really enjoyed it. What a great city to visit. Is NVIDIA worth the PE that it's at right now? So my short answer is no. Well, on the PE, I think NVIDIA is okay. It's just overall and NVIDIA, right, has just made it their business to impress the universe with their fundamentals. 51 would be a little bit pricey. 31 is a little more rational. But these guys have just been killing it, right? At some point, it's going to be too expensive. I think it's been too expensive, but frankly, I've missed on NVIDIA. I hit on Broadcom. I bought Broadcom. I made money on Broadcom. I more recently bought ASML. Doing well with ASML. Astera Labs has been a big winner. But this one here, I would say that, this is one of one. It's a very, very large cap business. And I do think their PE is too high. It's awkward to buy a business that's doing this well. It can't get any better, you would think. And we're going to have big, massive earnings coming from Microsoft, Amazon, Google Cloud, And what they talk about, their infrastructure spend is really going to move NVIDIA. If they talk about, hey, I think we're going to have enough, semiconductor capacity for the next year or 2 years, we don't have to buy much more. It could really bring NVIDIA's stock price down. I don't know if they're going to say that. We'll see what they have to say. So that is NVIDIA. Thanks for asking. All right. So we got through Intuitive Surgical. Bear with me. Let me try to get to one more earnings announcement. And Texas Instruments. This is a semiconductor company, but they're not in the data center. So they're not flourishing like NVIDIA, Broadcom, and others. Like AMD has been flourishing because they're in the data center. And these guys, year to date, not doing well for the 1 year. And the 5 year, not doing great either. And the market just didn't like their earnings. And these guys, what is their specialty? I'm not quite sure what they do. I know they do analog devices, but I couldn't tell you what products they end up in. So that's what's happening over at Texas Instruments. All right, let's get into some of these requests. General Motors, by the way, had a phenomenal day. They really hit really good earnings, and they were up 14.86%. Okay, I think the order we were going to go was LULU, and then we're going to talk about Adobe. So looking at LULU 5-year chart, not pretty at all. You've got a lot of volatility, and the stock's just been, left for dead, so to speak. And the reason that I treat this as potentially an opportunity is I recognize that the LULU brand has a lot of fans. I think a lot of people appreciate the brand, and they're also unique, right? When they came out with their apparel items, it wasn't like they were just copying somebody else and trying to do something that had been done before. No, they came out with a very fresh idea and took the market over. And so I give them a lot of credit for that. And I think their brand continues to have a lot of equity with consumers in that space. They've tried to branch out. I know they have like a tennis line, people that play tennis. Lulu's trying to get into that category. I don't know how successful that's been, but they're trying to branch out. Let's take a look at their growth. So we know their stock price isn't doing well. Okay. But let's take a look at other things that tell us about the business. It's a $21.5 billion market cap business, revenue of $10.9 billion, and PE ratio of 12.3, forward P of 14.83. So the PE ratio is nice and low. This is a consumer discretionary company, apparel, right? People don't have to buy Lululemon. It's a discretionary purchase. 26% discount according to analysts. Now this chart, right? You would think, okay, let's look at the financials. I'm expecting like revenue to be going down, but no, revenue is going up. So that's interesting. So the revenue is going up. Let's look at the quarterly to see maybe the last quarter is kind of a sign of trouble. And there is a little bit of a sign of trouble, although they keep getting bigger, right? So it's hard to grow these big numbers. It looks like their biggest quarter, as one would think, is the fourth quarter, which is when we have Christmas and a lot of gift giving and stuff like that. So they're still growing though. Okay. They're growing. Now let's take a look at other fundamentals like profit and so forth. And one thing I'll make a couple comments here first. Okay. Free cash flow has grown over time. Okay. Now they're kind of letting up on free cash flow a little bit, but I could see that the trend is that the number keeps getting bigger over time. Gross margins. We looked at Intuitive Surgical, and they make this really impressive machine, right? The Da Vinci machine. Well, they're a little bit north of 60% margins. And here's an apparel company that has a very good product, but they don't have to like buy like super expensive alloys and hire 100 engineers to design the darn product and so forth. And they're making almost the same margins, gross margins, as our friends over at Intuitive Surgical. They are operating with a good operating margin. Profits are there, and free cash flow margin is there. So these fundamentals are good. So what's going on with Lululemon? Why is the market hating this company? So let's take a look at, I'm going to just double check the balance sheet just to make sure, some of these companies I know well, and I know they have good balance sheets. And this one here has a decent balance sheet. They've got just a little bit of debt, $606 million. When we go debt to EBITDA, less than 0.5, which is very good. If you're less than 3, you're acceptable. If you're near 0, you're exceptional. Very good job, Lululemon. Got good cash. So we've got some analysts that believe this stock could really rise. And the worst case scenario, the stock can come down to 120. So there's a consensus discount available on the stock. Now they're going to be kind of a slow grower, much slower than in the past, right? In the past, especially when people had all that COVID stimulus money, I bet you they were buying yoga pants left and right. And now they're having a hard time growing, but they are growing. If you look at like Nike, they're not growing at all. And that stock's in a lot of trouble. This stock's being treated like Nike, but they continue to grow. They're going to expand their profit. That looks good. Their profitability, for some reason, in the year that we are in, is coming down. Maybe those tariffs are hitting these guys. And the PE ratio is going to maintain a very low PE ratio. So, I mean, I'm seeing value. I'm seeing definite value on Lululemon. Let me show you my valuation on Lululemon. I have one on them. And then we'll talk about, how I look at it potentially investing in Lululemon. Now, nothing that I ever share is financial advice. I'm just sharing my analysis, my research. I hope you find it interesting, but it's never financial advice. So their cash flows looking good, growing them at a modest rate. Their earnings per share, growing that by a modest rate. You get a 28% discount. Now, that's not a super compelling discount, right? It's a discount. If there's something there that is going to make the business stronger, more exciting, that'd be an investment I might make. But I'm like not quite there on Lululemon. Partially, the lack of conviction that I have is I don't know women's apparel. I just don't. I barely know, men's apparel. I think I know what guys like to buy, but it's a kind of guess on what women like to buy and how much they'd pay up for Lululemon gear. So I'm right there at the kind of the boundary. I would want to know, what's going to be the catalyst that's going to make a positive impact on Lululemon for the next year to 2 years. And if there's a catalyst like that out there, then that'd be great. That'd be pretty good investment. But I'm also taking on risk because I just don't know this space well enough. I'll leave it up to others that know it better. I own 0 apparel companies. It's not my favorite industry to invest in. I could just give you the numbers and say, hey, this is where I think the valuation lands on Lululemon. If you know apparel and have a better sense for it, where it's going, you might be able to do more with this data. So thanks for asking about Lululemon. And I hope you found the analysis interesting. All right, so let's move forward. We covered Intuitive Surgical and make a couple of notes here. Now let's head over to Adobe. But before I head over there, let me say hello to a few people. And it looks like Shadow Guy. Yeah, there's a lot of earnings coming out. Hard to keep up. Mike, the dividend investor guy. So Mike, I've got Dow, and I think it's Upstart on the list. That's after Adobe. And we've got Magical Self. Would you invest in MRK now? Yeah, so you have two questions here. So would you invest in MRK? So I'll put that on the list. And then talk about DCTH. And that stock has had such volatility. It's like, man, I've kind of been observing the stock and I'm like, holy smokes. Over the weekend, and I'll talk about it when I analyze it, but I'll show you the volatility of where that stock's been. And that type of volatility makes me pause, like, whoa, what am I not seeing? What am I not understanding in that stock? Thanks for asking about those. Got them on the list. Just hang tight because we're going to be going through a couple of others before. Blocks for fun. Good to see you. Thank you for joining the stream. And everybody else, thanks so much for joining the stream. Toby, 1892, Killer Rabbit. Good to see you guys. Thanks for joining. All right, back to the stocks that we want to take a look at and analyze. We looked at Lululemon. Now let's take a look at Adobe. Adobe has been really, the market has this story that AI is going to take away the need for people to own or subscribe to Adobe software so they can create the things that you create with Adobe. And I get that. I think AI should make the process of maybe creating content, whether it be an image or a video or whatever you're doing with Adobe. Maybe you're doing an ad for a particular company or a client. All those things, okay, should it get better? I think it should. But to think that AI is going to replace Adobe, I think is too much to accept on my side or to agree with. The best I can agree with is most definitely over the next 5 to 10 years, I think the way that we create things is going to be very different. And it should. Our technology keeps getting better and better and better. And AI is going to be part of that innovation, the tool set that helps us create stuff that's even more impressive and looks great. But between now and 5 years, Adobe, I think, is going to be fine. And I just shook my head and I'm like, I know Adobe, it's a good company. And now the market's telling me, hey, you got to be careful because Adobe's going to start to see their revenues go away. They're going to start seeing their profits go away. So that's kind of like, is that a message that I should take and really run with or bring into my process? Or is it noise that I need to somewhat ignore and actually use, for the purposes of making money? So let's take a look at that. So I'm going to start by looking at the 5-year. This stock hasn't really done much. Look at these sell-offs. Now this one here, everybody was getting sold off in 22. So that one's maybe not the best example, but this was a success story. Continues to be, right? The 1 year tells us that AI, right now, the investing is very concentrated on the data center, which is, you think about it from a business logic perspective. Eventually the biggest value out of AI, it's going to somewhat resemble what we saw in the dot-com era, right? It didn't end up being Cisco or the providers of the infrastructure for the dot-com era that ended up being the most valuable companies. It wasn't AT&T, it wasn't Cisco, or Sun Microsystems was huge back in the day. They really flourished for a number of years. And we're seeing right now, the obvious trade is data center. If you're in a semiconductor, if you're a hardware producer for that data center, you're doing well. But it's going to be temporary because at a certain point, there's going to be more competition. For example, DeepSeek in China kind of woke everybody up and said, hey, they did it for far less money with less technology. So that should be a very big warning to all AI companies that if you keep building a super expensive solution, platform, code base, that's going to be a liability. It's not going to be an asset. Because if your competitors build very efficiently, very economically, they're going to have a huge advantage over you for people to develop on. When you look at like DeepSeek, it came out, and after it was proven to be a legitimate large language model that was built using principles that were far less expensive, you saw a dramatic increase of US startups using DeepSeek as their preferred large language model to take advantage of the cost efficiencies. So I'm kind of going off the rails here a little bit, but I'll just kind of end that kind of little story with the dot-com bubble ended up creating some of those most valuable businesses that we know today. Amazon, Google Alphabet, Meta. Meta wouldn't exist without the internet. And you got a lot of other businesses that are flourishing. So we really are going to see some AI businesses. Maybe OpenAI might be one of those businesses that become incredibly valuable, but it's early, really early. And we'll see what ends up being super valuable. But between now and then, I think Adobe is just, for me, it's a definite good business that has number one market share in its respective market. For creative people, Adobe makes the best products. They're $149 billion market cap. They've been sold off like they're completely undesirable. Revenues at $23 billion. The PE ratio, 22. And then forward P, 15.6. Now you look at this graph, you look at this PE ratio. We just looked at Lululemon. You saw how their revenue is decelerating. Deceleration of revenue, that could concern people. Let's take a look at Adobe. No deceleration, folks. In fact, it's impressive that they keep getting bigger, but their revenue percentage growth is staying at the same velocity. That's really good. Well, maybe their profits are being taken away because this AI thing is taking away profits. Nope. That ain't happening. Gross margins, 89%. Profit margin of 30%. Operating profit, 36.5, 41%. Sign me up. This business makes 89% gross margins. That's exceptional. Visa, the big, network company that everybody uses their network if you're using a credit card, they have higher margins. But there's only a few businesses at scale that are better than that. So their profitability is going up. Revenue is impressively just staying at the same percentage growth. And the market's selling these guys off. What is wrong with the picture? What is wrong with my analysis? I keep asking myself, where am I missing it? Cash is as much as debt. You have very little debt. So debt to EBITDA, really low. They're buying back shares as they should be. Just buy back a bunch of shares. The forecast, analyst, 21 of them, they think it's discounted by 28%. Some analysts are, believing the market's nuts. This is a $590 stock. And some analysts are like, no, I understand what the market's saying. It's a $280 stock, but the consensus is that it's discounted by 28%. And looking at the consensus forecast, they're going to keep growing. They're going to end up being a $31 billion revenue company. Their profits are going to keep getting bigger. Their forward PE, again, company has 89% gross margins, 30% net profit margins, high yields of cash, and they're going to be priced with a 13 PE with a 10% growth rate. We just looked at Netflix to start this stream. Netflix is at 17% growth. That's good. That's really good. Their profits are nowhere near Adobe's. Netflix is way down the percentage of profit. Netflix is at like 60% gross profits. Net profitability is like 20%. And so these numbers look far more impressive than Netflix. If you look at the rate of profitability, yet the market just does not believe in Adobe. Now, I've made money on stocks, seeing that and saying, this is an opportunity. And this one here just has not done what I mean, we're talking, it started the big sell-off in 2023. We're going 2 years into this trend. 2 years. At a certain point, I started to buy, but the market just hasn't changed its sentiment toward Adobe to the point where I'm like, I got to get rid of some of my losers, create some cash, have capital ready to feed my winners. I've got some terrific stocks in my portfolio that really are working, and I'd rather have capital available to make money where it's working. So, and blocks for fun, you're asking about the dip in 2022. 2022 is a little bit of everybody took a pretty good haircut because stocks came out of the pandemic era and things got a little too overheated and then they sold off. So let's take a look at Adobe and we'll compare it to the NASDAQ because they are a tech company. So I didn't know how to spell NASDAQ here. NASDAQ. All right, here we go. So compared to the NASDAQ, right, here's Adobe. Let's go 5-year. And you'll see that the NASDAQ over the 5-year did kind of get slammed as well. Here's the NASDAQ. It's done much better than Adobe over the last 2 years. You see where Adobe stopped correlating with the NASDAQ 2 years ago. But in 2022, stocks sold off because the market got way overheated. This is probably going to throw us off, but yeah, it doesn't look good. So coming out of the pandemic era, we were given really low interest rates. We went into 2021. 2021 was a boom year. And then interest rates were moved higher because we had an inflation issue. The Federal Reserve's like, oh my God, we have supply chain issues. Now people are paying $50 for a package of toilet paper and things were getting nuts. You guys remember that era. So when they raised interest rates, it caused a big sell-off on Wall Street. It was just too much appreciation. 2021 met with economic conditions that were going to hurt equities, and profits were not that great. But where I'll point out to is here's where Adobe, the market decided we don't like Adobe, and it stopped keeping up with the NASDAQ or at least correlating with it. And that's the opportunity, this big divide. A stock that I would say is what I thought was going to happen with Adobe is Google Alphabet. So we have Google. And if you look at Google for the 5-year, and again, I'll compare it to the NASDAQ. So Google has performed a little better than NASDAQ, most definitely. And that doesn't really show me what I wanted. That doesn't show me what I wanted. What I wanted to see was that for a while, yeah, it does show me. So Google for a while this year, OpenAI is going to take Google's business away. The Department of Justice is going to go after Google. Search is going to go down. So the market was kind of brainwashing itself into having a negative sentiment over Google. Meanwhile, it had a PE ratio of like 24 and it continues to grow, super profitable, just a great business. And then the market goes, yeah, you know what? We're wrong about Google. And then boom, it went up. So if you look at the rate of improvement on Google from its low to where we're at now, it's up 71%. And I'll just kind of go back a couple months. If you had just bought Google here on August 21st to now, it's up 25%. So it's just really, the market's really realized, hey, oops, Google is going to be awesome. And everybody piled into Google. This is a massive cap. This is a $3 trillion market cap company. I thought I do believe that's going to be the story on Adobe. It's just taking so darn long that at a certain point, I'm like, Adobe's not going up while the market keeps tracking higher. What is going on? So as soon as Adobe, which now that Adobe is beginning to go higher, maybe I do, I'm paying attention to it. I own Adobe stock. I've just been dollar cost averaging out of the stock. And it went up 14%. No, 4%. Excuse me. Whew, I was going to say, well, I missed that. 4% higher today. Over the 5-day, it's up 7%. 1 month, it's down 1.79. So, you know what? It's had a couple good days. Very good. 8.6 over a couple of trading days. It's not a trend yet. If it starts trending higher, I am going to pile into Adobe. I'm going to buy, similar to what I've done with United Healthcare, just buy as fast as I can and take advantage of a discounted stock that has great fundamentals that it will double in value. We just need it to get started. It's been a painful process to see this stock sit where it's at. All right. So I beat up Adobe enough, or it beat me up enough. Let's move on. Let's move on to Dow. And Dow is a stock. It's a material stock. What's going on with these guys? So when are they going to announce? October 23rd. So that is on Thursday. Excuse me I have some water. So they're going to announce on Thursday. And these guys, boy, talk about sold off. Year to date, 45%. Now, I thought these guys were on the comeback trail, and they surprised me. Look at this chart. Not good. Now, this is a very well-known name, Dow, right? They have a lot of chemicals that go into other products. They're a very well-known company. And especially this past year, they've just been on a sell-off. Part of it, they deserve it. And let me get into that and show where I think the business just isn't on the right track. They're not showing great fundamentals. Now, it has a high dividend, but I don't invest on dividends. There's one exception being real estate investment trusts. I take the dividend into account. Other than that, if I'm going to focus on a dividend, I'd rather buy a bond and just focus on yield. because I can definitely get yields in bonds that look really good. But if I'm going to buy a stock and take the risk of a stock, I want appreciation. I want to be sitting on a 3-bagger, a 10-bagger, big appreciation someday. So these guys here, we're seeing a contraction in their business. Now, back when we had those supply chain constraints, these guys were printing money. Man, we get to charge more for our commodity. Isn't this great? But now they're really contracting. And this is what is like scaring me. Guys, why is your revenue dropping so fast? And looking at their profitability, they're losing some money. Okay, so they lost money in the trailing 12 months. They made some money last year, made some money the year before. Free cash flow, negative in 2024, much more negative in the trailing 12 months. That's not looking good. If they could revert back to some of their historic cash flow, like just get to 2 billion, this business is going to, the stock price should flourish. It's just they're in a zone of, man, this is really bad. Like, how are they burning so much cash? Where's the cash going? It's like, do they have to retool the whole production facility? Or they have multiple facilities. So what is the big problem? How are they going to solve it? So I tracked this stock. I had a small investment. It didn't do well. I got out. I'm glad I got out. And I'm not sure that they're out of the woods yet. They have to start showing some constructive actions toward becoming profitable again, generating free cash, having, a sales where they have some pricing power. If they're just completely subject to commodity prices, and the commodities don't work for them, it's going to be a painful ride for them, it's already been a painful ride. It's just going to continue to be painful. You see their margins came down. So this one here, it's just, it's in a bad place. So we're going to get an earnings on the 23rd. Looking at the earnings, I'd want to see, again, a constructive path toward profitability, getting to free cash flow again. I know of other material companies that even though the commodities have really come down in price, they continue to be profitable and generate cash. So why can't you do it, Dow? What's the problem? You guys have been around forever. You should have a management team that's seen this before and can adapt. So far, you're not adapting. You're getting run over by the market. So this one here is not looking good. I don't know that I have a valuation on Dow, but let's take a peek. Yeah, I do. Okay. All right. So looking at the 4-year average, if they can come back, this is more of an example, kind of like the art of the possible. If they could just get back to their 4-year average, which is including some of these horrible years, they're very discounted. So if they get on the road to recovery, if they start showing a constructive path to profitability, to free cash flow, at the right time, this would be a really good investment. And that's a situation on them. It's like, I've got to wait for these guys to get their act together. Once the market recognizes that the act is together, then I'll buy, and then I'll, pile in. That's the way I'll play Dow. And we'll see what they announce in a couple of days. Thanks for asking, Mike, on Dow. And should be able to cover it toward the end of the week. Once they announce, we can take a look at it again. Next stock is Upstart. Let's talk a little new generation finance. I wanted to talk about Philip Morris because these guys, looks like people are not smoking enough. So not buying enough of Philip Morris products. So we're going Upstart. Upstart was up 4% today, but let's take a look at the year. Boy, this has been, whoa, man. If you want some excitement, I've got the right stock for you. Down 14.96 over the year to date. 1 year, you're almost back to even. 5 year, wow, look at that. They were just sky high. I think blocks were fun asked, well, what happened in 2022? Some of this happened in 2022. If you recall, this is where we had the GameStop, short sell, where you had a lot of meme stocks just going into the stratosphere. And if we have too much of that, we just have gambling in the form of just bidding up stocks way above what they're worth. And then they come crashing down like this example. Now, this is a real business. They were just young back in those days. And these guys have a viable business. It's a $5 billion market cap, $884 million of revenue. Forward P looks pretty decent, depending on growth. Let's take a look at growth. So what does Upstart do? I need a reminder because these new companies, I always have to get reminded of what they do. So these guys are doing personal loans with low fixed rates. All right. Personal loans, car loans, short-term relief. Got to pay some bills. Got to buy some Taylor Swift concert tickets. Must have it. Give me a loan. And then they go get some Taylor Swift tickets. Home equity line of credit. Okay. Now we're talking. All right. Look at that. Okay. So this is their portfolio. Now, this is not a new category, but these companies tend to provide a better experience for the customer, for the consumer. They come in, they find it easy to create the loan application, get things started, get things completed, get access to those funds that they're looking for. So I'll give them that they probably give the consumer a much better experience. Now, these guys are growing. Man, look at that growth, 53.62%. Now, let's talk about interest rates because interest rates are going to be super important here. Interest rates are going to help Upstart in a big way. You have lower interest rates. I think consumers are going to be like, yeah, I'd love a home equity line of credit because, let's say in 2023, they're like, I'm not going to pay 8 or 9% on a home equity line of credit. But nowadays you're like, well, it's going to be 5 to 6. Oh, okay, I want one if it's going to be that low of an interest rate. Or, you name the loan. So as Upstart has access to cheap money, I think the attractiveness of their product is going to go up. So I think low interest rates are going to help Upstart. Revenue growth of 53% looks good. And I wonder, we'll look at their income statement because I want to know, are they making net interest margin or are they making a transaction fee? It's important to know that because it's going to be a big difference in, are we going to treat them like a bank or are we going to treat them like a fintech? And I can tell you right now, we're going to treat them like a fintech. This gross margin, 81%. So they're doing a transaction fee and they're probably selling the debt off. They're kind of a brand online, but if you do a home equity line of credit, it's probably some other financial institution that's actually going to take the loan. Once it's made and it's fully done, you're making your payment, or that borrower is making payments to some institution. It's not Upstart. These guys are just creating the paper and passing it along to one of their partners. That margin's looking good, looking real good. And yeah, so that margin looks good. Let's take a look at their balance sheet. Balance sheet, they've got $400 million of cash, $1.54 billion of debt, so $1.14 billion of net debt. Whoa, what's going on here? They don't have any profit. That's why we're seeing a crazy number there. So $1.14 billion. Okay. And their market cap is $5 billion. All right, let's go take a look at their financials, because these businesses are pretty unique, and Stock Analysis is a great website, but sometimes they kind of they over categorize and generalize information. And I'd rather take a look at their true financial statements, which will really give me a clear understanding of their business. Okay, so we've got, I want their 10K. Where's their 10K here? Okay, so here's your balance sheet. So let's see what kind of debt they have. So this is as of June 30th. We've got $395 cash. Restricted cash is probably either it's the customers or it's the partners, right? So they have borrowings, but you see, this is why I look at the balance sheet. You see this line here? So they probably are carrying these loans temporarily, and then they're going to basically, they have an arrangement with some other company, and they're going to transfer that particular loan over to them, and that company, let's say they're doing this with JP Morgan, and JP Morgan goes, perfect, we'll give you 95 cents on a dollar or 90 cents on a dollar. Perfect. So here's $1 billion of loans. You give me 900 million. Perfect. And then they move on. Then they convert that back into cash. So I'm treating this as almost cash. They just have to sell off this loan. Okay. So it's not quite $1.4 billion of debt. It is, they're pretty much at even, right? This is 1.4, this is 1.4 billion. All right. Glad that I looked at that. Told me a lot. Let's take a look at some other financial statements. So here's our revenue, 3 months, 6 months. So the 3-month total revenue, 257, looks really good. So see how revenue from fees. So they're just charging fees. And they have some interest income, interest expense. I think this is net interest margin, but it's very temporary. They don't want to keep these loans. They want that capital back. They want to move on to the next customer who wants a loan, give them a loan, and then move on. It's almost like Rocket Mortgage. Rocket, and that's the wrong example, because I think Rocket is also servicing their own loans. These guys are basically wanting to originate the loans and then sell them to another financial institution that wants to carry that debt, service the debt, earn that interest, and so forth. So good to know. They are making money in the quarter. They're making money for the year. That looks good. Shares outstanding. They are issuing more shares. Now, the share count did go up substantially, right? If you look at the 1 year, the share count went up roughly about 8.5%. That's a lot. It's like, what are you doing? Why are you issuing out so much shares? You're not giving that to employees because that's too much. They're issuing out shares for some reason, maybe capitalizing the business a little better. But that is a pretty good jump in share count. Maybe that's why the stock hasn't been working, is they rubbed investors the wrong way. It's like, dude, you're liquidating the company. Don't do that. All right. So here's their statement of cash flows. We got a little bit of profit, and you got ups and downs. So here's some purchases of loans held for sale. So this is kind of like inventory for a supply chain like company. And then this is proceeds from the loan sales. Okay, that makes sense. And those numbers almost equal out each other. So a little bit in the negative on operating cash flow. I'm not too worried about that for now because they're little. They're a tiny little company. So one red flag. Why did they issue so many shares? You issued more than 8% of shares year over year. What's the story there? And don't do it anymore because you can't liquidate the company like that. You're just not going to be a desirable business to investors that see what you're doing. I think lower interest rates is going to be a total green flag for these guys. I think they're going to be operating with, running downhill with low interest rates. I think they're going to do well in that era. So this is an interesting idea. I think this is an interesting one. Now the market, Adobe, I showed an example where the market just has it out for a stock and just crushes it. And I think for the last 3 months, we've seen something similar with Upstart. The market has not liked them, not confident about them. November 4th, they have earnings. And I think it's a nice investing idea. It's high risk, but I think there's more positives than negatives. I think it's valued properly. I think it could do well in the future. 13 analysts cover it, 42% discount. But look at the range of price targets. One analyst, this is a $108 stock. Another analyst, this is a $16 stock. Man, very, very broad range. It's expected they're going to keep growing. Very good. So high risk, but looks like a pretty decent opportunity. I can't do a precise valuation because we've got a lot of negative numbers involved. Let's see what I've got. I think I've got something on these guys. Let's take a look. Here's Upstart. And I did a valuation. Here's earnings per share. And I trended to this number, 55% discount on earnings per share. That's the only valuation I can give them because they don't have any positive cash. But we have to wait for the market to figure them out, or if Upstart has a positive earnings, this thing can really go places. And they have to stop issuing out so many darn shares. That's important because you can't keep issuing out shares like that. This just makes everybody uneasy. Like, what are you guys doing? If you need more capital, maybe you should just borrow some money for a while. You're in the lending business. You should be able to do that. All right, moving on. Let me catch up on some comments, and then we've got MRK, DCTH. I can find the comment or the question. I think it was this one that we're going to work on. Magical Self. Would you invest in MRK now? What size, portion size? Okay. We'll go into that. All right. And then we got Big House Juice. What's my favorite Mag 7 right now? It used to be Google, but now it's Meta. Google's gone up in price really, really well. No, I'm sorry. Jeez, man. Confusing myself. Amazon. Amazon's my favorite right now. Amazon's being counted out, and Amazon's been doing great lately. And I've been buying Amazon left and right, talking about it for months, saying how the market just doesn't understand how valuable Amazon is. Who cares if they created a giant outage yesterday? Their stock went up. And I'm wearing my AWS hat. So these guys are really, they're cut from a different cloth. They don't necessarily care what their stock price is. They care about is being the strongest, best business, period. They want to obsess on the customer. They want their customers to be like, there's only one Amazon. We love Amazon. We love doing online shopping on Amazon. We love Amazon Prime. We love their robo-taxi service, Zoox. We love Amazon Web Services, except when it, they create a big outage, then we don't like them. So Amazon is the answer to your question. And in second place would be Meta. And in third would be Google. And that's what I would say to that. Cartel Raider. Flag on the play. I think you were commenting on my comments. So this company is totally AI operated, and I think you were going to Upstart. Possibly. I don't think so. I think they're using AI to some extent, but I think a lot of people are just kind of loosely saying, oh, AI is doing all kinds of things. And I think AI is going to have potential, but I don't think it's doing as much as people would like to think. All right. So we're on to MRK. Merck. Oh, okay. We're talking Merck. Old school pharma. And old school pharma has just been getting slammed. Back in the day, these guys used to be cool. They used to make lots of money, but not over the last couple of years. These guys have just been getting hammered. Now, Merck they kind of deserve some of this. Now, the question was, would I buy Merck? And without any analysis, the answer is no. Let me take a look and see if maybe I'm wrong. I have a valuation on Merck. I've been invested in Pfizer. I just got out of that. And I'm trying to get out of Novo Nordisk. These big pharma stocks have just been, they've been losers. And I wanted to kind of think about what would be a good analogy. It's just the market doesn't like them, and some of it is earned. Let's take a look. All right, financials. So they're a $218 billion market cap. Merck is a historically an awesome business, right? I mean, they've been around. They've created some pharmaceuticals that have helped a lot of people, and revenue is $63 billion. So they've got plenty of revenue. PE is really low, and the reason for the low PE is they're not growing anymore. And their dividend is really good, 3.7, right? Analysts do think that there's a discount on stock. And 5-year, not getting it done. 17% is not good. That's not good enough. You got to be near 100, over 100. Make it 200. Then you're getting the job done. So the 1 year, obviously, this is not good. Now, their revenue is not growing. They're just barely, inking out a little bit of growth. Last 2 quarters, they're contracting a little bit. So that's not good. Okay. So we have a business that's not growing. Red flag. Free cash flow. They do have a very beautiful number. $14.7 billion is $14.7 billion. There's no if and buts about it. Gross margin number looks beautiful. 77.4%. Right? And profit margin looks great. So these guys have a lot of money. They just can't grow. It's like, how can they grow? Do they need and I think it's their discovery arm, right? They haven't been able to discover any big successful drugs, some new ones that is helping lift up that revenue. And that's the problem they have is low growth, no growth, market's not excited. And their cash flow looks great. Let's take a look at their debt, just to make sure these guys, if they have any debt. They do have some debt here. They have like $27 billion of debt. Debt to EBITDA 1.23. Okay, that's not a problem. Below 3. But Merck is just not an investment that I would make. It's, for a dividend investor, I get it. I think it's a decent choice for a dividend investor. I'm not a dividend investor. I'd rather take my chances. I'd rather buy Amazon and be sitting here 3 years later with my investment doubled. That's what I want. And I don't want 3%, 4% dividend yield. So this one here is for somebody else, maybe somebody that's looking for income. And pharma's just been a hard place to invest. These guys are going to grow a little bit better. Earnings are going to get a little better. The PE is going to really drop single digits. But the market's not really paying attention to this area. I have done better with smaller cap pharma that's growing really well. So United Therapeutics, Catalyst, those are doing well. Speaking of which, we can talk about DCTH next. But that's Merck. The answer to the question is I would not invest in Merck. I think it'd be a waste of time. My capital would be tied up. And I hope it does well. I think Merck's a good business. They've been really important to the healthcare space for a long time. All right, so let's talk about DCTH. And let me go over here to see if I could keep up with this stock a little better. So Delcath Systems is a neat little company that made it on my radar recently. And it made it on the radar through the weekend stream. Somebody brought it up and said, hey, look at Delcath. And after hours trading, this thing was trading 26% higher on the preliminary results that were released about their revenue growth and their free cash flow. And then the market decided, no, actually, we don't like the earnings, and it's sold off, which was interesting. I'm looking at the 1 month. So this stock hasn't been doing much. And the 5-day, it's kind of back to even. Now, Delcath is a really small cap. And as we look at these small caps, they're just much riskier. And man, these guys, they have a treatment for liver cancer. It's really isolated treatment. They just went commercial with their drug, with their treatment, and they're really growing well. I think it's discounted. But it's one of those that, man, is the market, what's the market doing with these guys? You would think the fundamentals are good, but the market's just beating this one up. So I think, let me make sure I answer the question you're asking. Would I be comfortable investing in DCTH? Man, no. Because they provided their financials in a preliminary report. The market basically didn't like it. They were like, that's it. Don't like it. So what's going to be the upside? So I'm going to have to wait 3 months, or I guess 3.5 months, because their actual earnings will come out November 4th. And then 3 months after that will be January 4th, or February 4th, excuse me. So the answer is no, I should not invest in Delcath. Now that's me. If you're a young investor, and let's say you're a young investor and you really understand medicine and you understand what these guys do, and you feel like the market doesn't understand, these guys are really good and they're going to be very popular in the medical community. Hey, that's your opportunity. You should be able to do something with that. But for me, I'm not that person. I'm not a medical professional. And I'll let other investors either take advantage of or understand this better. For me, I'm just seeing too many red flags. Like, the preliminary results were put out. if they were really good, the stock should have been trading higher. It hasn't. The market's been trading higher. So it's not like the market's selling off. So the answer is nope. I wouldn't buy it this time. I'd wait 3.5 months for the next earnings, get some more data. If I'm a little late, and let's say I missed the first 10, 20% rise in this stock, I'm sure it's going to keep rising. And I'll make, I don't know, whatever, 20, 30, 40, 50%. I'll probably be in and out of this stock like for a year or so, because they're going to grow for a period of time, but they're not going to be a stock at this point. From what I know, they're kind of a one treatment kind of company. And I don't know how long they're going to do well for. So that is Delcath. All right, we're cranking along. I think we've covered 10 different stocks to this point. Let me check in on the chat, see what's going on with the chat here. So yeah, I am somewhat of a ball cap collector, excuse me. And some of my favorites are universities that I've attended, my kids have attended, my wife's attended. So you've seen me with a Penn State, ball cap. One of my sons attended Penn State, and LMU, Long Beach State, Cal Poly. And what am I wearing? Oh, I'm wearing AWS. So this was given to me. So it's a freebie. And I thought it was fitting since it caused a big outage yesterday. So Ben 10 recently got out of Pfizer. Pfizer, I thought that the market was going to like it more than it did. And it just ended up, my capital was just idle, and I got my capital back and I'm ready to go. Cartel Raider. Let's take a look at Path. I would like to look at Path, and I think it's UiPath, right? And I think that's a really interesting stock. Let's take a look. Pedro, good to see you. Yeah. Yeah, the share dilution, I usually am not freaked out about, just a little bit of dilution if they're giving employees, shares so they can keep those employees, because these startups, that's their big lure for talent. But that's a big share issuance, and that's a problem for me. I'm sure other investors feel the same way. It's like, man, that's a lot of shares. What are you guys doing? All right. So we're in the AI world, right? We've got AI is going to do so many things. Now, there's some really good examples out there right now that we can get our heads around, like Waymo. In certain cities, you can get on the Waymo app, call for a ride, and a car, which is basically a robot, shows up, picks you up, takes you to where you need to go. That's awesome. So there's some examples of AI that are real. And something that's supposed to be a very big value or a big trend is going to be agentic AI. These are going to be agents that do tasks. Maybe these are tasks that are redundant tasks. Take them off your plate. Maybe a business is like, why do we have a team of 100 people that are answering these simple questions? Why don't we just have some AI agents answer those questions? And the customer will be happy because they can ask questions 24/7. We're going to be happier because we're going to be more profitable. And it's not a great job to begin with. So those employees can go do other things that are more important. Now, UiPath, what do they do? UiPath provides an end-to-end automation platform that offers a range of robotic process automation solutions, primarily in the United States, Romania, UK, the Netherlands, and internationally. The company delivers software robots that emulate human actions with precision and speed for organizations to automate repetitive tasks. So we're right in the heart of AI. This is where AI is supposed to deliver value. Okay, this is it. Let's take a look at their website. Now, somebody I worked with, didn't work with her for very long, and I didn't really get to know her all that closely. And this is like 20 years ago is when I worked alongside this person. She works here. So she was really excited about being there, and good for her. These guys are a recognized leader for AI augmented software testing tools. So I guess this is going to do testing, right? If you look at, like when you're delivering like a new software platform, you want to test it, and you have these testing tools that you would use. But you can do testing in a variety of ways. Like you might test the stress test a particular system. Like we had this big outage. You want to quickly test that all your systems are operable. That's another example of testing. So let's take a look at the solution. So we have agentic use cases in healthcare, banking, insurance. So this is where AI is supposed to deliver the value to the business, to businesses, to the economy. This is what, like, the leader of NVIDIA, we're in an industrial revolution. AI is going to be so awesome. Well, this should be one of the examples of where AI is delivering real value. And I'm really setting it up because when I look at the revenue growth for this business, I'm like, where is the beef? Why is this business not growing? Why is the AI space exploding like a star that just exploded? And it's, the pieces from that star traveling at 10 times the speed of light. But this business that's right in the heart of AI is growing at 8.25. What? Adobe is getting killed and they're growing at over 10%. So these guys are supposed to be disrupting everybody else. I have nothing against UiPath. I think they're a cool company. I think they have a cool solution. But why are they not growing faster? We got this AI freaking, party going on in the data center. Data centers getting built out, man, like crazy. But then you have a real AI related company. It's just barely growing, and they're small, 1.97. Now, if these guys showed better growth, I would be all over these guys these guys are going places. But there's something there that maybe customers are using the platform and going, yeah, this isn't going to work for us. We're going to have to go back to people doing this task because the agentic AI is making too many mistakes. The agentic AI doesn't fit the way we like to do business. The agentic AI just isn't going to work for us. So I really like this business, but I don't like the fundamentals. They're a small business, supposedly operating in an AI industry that's supposed to be exploding, but I don't see any explosion here. I'm seeing 8.25% growth for the full year that they closed on January 31st, 9.3. It's like, well, come on, like show me some awesome growth. And it's not there. They do have good margins, very good margins. They're not making money yet, not a problem because they're little. They do have free cash flow. I like that. I just need to see them grow. Because if you're going to grow slow like that, I don't want to be a part of it because that just means the market doesn't love your product. And very quickly, somebody else is going to take your market. You have to expand fast to capture the market. What are analysts thinking about this company? We got 16 analysts coming out. When these guys IPO'd, they were the cat's meow. Everybody was like, oh man, this is a for sure winner. 18% price target is the best. 10%, a $10 price target is the worst. They're priced 17% too high, according to analysts. I don't like this forecast. You're not growing fast enough. You're little. You have to grow fast. We have like in cyber stocks, like Sentinel One is about $1 billion in revenue. They're growing 25%. You have a lot of businesses that are this small growing 50%. So this is my big problem with UiPath. I love their business. I think their business is cool. I just, I'm not seeing that these guys are effectively capturing the market. Maybe the market doesn't even exist for what they're going after. There's just something missing here. So the market thought, man, these guys are for sure going to take over. They're going to be so awesome. They're going to be an AI company and everybody's going to use them. They're going to make lots of money. And then since then, they have sold off and really just abused investors, unfortunately, going from 79, almost $80 a share down to 16. That is horrible. And I stay away from IPOs. Here's one more example. So this one here, UiPath, I do have a valuation. I hope they make it. I think it's a cool company, but you know, sometimes you look at what the market's pricing the stock by. You have to sit back and go, it just doesn't sell. They're just not creating enough revenue. I think they're 15% too high. So I'm agreeing with the analyst. It's priced too high. It's not exciting. They have to grow faster or they're going to be irrelevant, not noticed, not important. So UiPath is not where I'm going to invest my hard-earned money. So thanks for asking about Path. It's a good company to look at. Again, I'm a fan, but you know, we got to look at fundamentals. That's why we look at them. Yeah, cool, man. And you know, just talking about baseball for 10 seconds. Dodgers, Blue Jays. We'll see who takes that. Blue Jays have been tough. We'll see if they can handle the Dodgers. Dodgers are on a roll. So you want Amazon below $200 per share. Let's see if we can make that happen. Man, well, we haven't seen 200 in a couple months. So May. I don't know, Mike. I don't think we're going to see that. I think 200 is something that's going to be in the rearview mirror, getting smaller and smaller and smaller. I think Amazon's discounted by 29%. I also think that Amazon is going to announce and their stock's going to really flourish. I think the Amazon stock's probably going to be worth $600 a share in the next 2 to 3 years. So I think it's going to go in the other direction. And it's, you know that I've talked about it for 2-3 months. I'm probably wearing everybody out about Amazon. And I think it's headed in the right direction. It's had a couple good days during days when I don't know how the market could have the stock go up like a 1.5 on the day that it had a massive outage. It's like, man, I guess investors were set to buy the stock. It went up 1.2% on a day when it had a massive outage for AWS. And then it continued to rise today. And today, you know, our friends over at Google, they went down, you know, on the news that OpenAI launched their own browser. I think it's called Atlas. And I think the sell-off is overdone because, I mean, hey, I get it. OpenAI is cool. They're kind of like the new shiny object in the market. But man, call me up when Atlas has 100 million users, okay? Because Google Chrome has like 1 billion or 2 billion users. There's no threat to Chrome. Maybe if in 10, 20 years, but for now, is it really a threat? Come on. Another story where it really lowers Alphabet pricing. To me, it's an opportunity. Now, I own so much Alphabet. I think it's my number one holding, like from a value perspective, from a price perspective. So I'm not buying any more shares just because I own so much of it. But every time a great business gets, gets counted out, it might be an opportunity. So I just throw that in there. I think Amazon's going higher. I think Alphabet's going to keep going higher. So Killer Rabbit, rules of engagement. If you'd like me to look at Vertev, $5 super chat, or you become a member of the channel and it just comes with your membership. So those are your options. Thanks for attending. I really appreciate it. Okay, so I have more stocks to go with. And if you guys are game, I'm game on continuing. I wanted to look at some more stocks that have announced. Let's keep on keeping on. One of the stocks that announced today was Chubb. What's going on with Chubb? Not much. And Chubb is an insurance company, and they haven't been doing great. They're year to date, they're down a little bit. Over the 1 year, they're down more. Over the 5 year, they're doing great. Really nice rate of return for 5 years. But you can see that really for the last 5 months, no, that's too much. 3 months, they've been going flat, and they've had some pretty bad days. This is a company that Warren Buffett is an investor in slightly. They own all of Geico, and that's where most of their insurance related investing is for Berkshire Hathaway. But these guys have some really good metrics. Let's take a look at their earnings and see what they had to say. See if there's something interesting in what they released. All right, let me first make sure I'm looking at the right. Wish they would just put a date on here. So am I looking at the right one? Somebody get me a date. So here's September. I don't know if this is what I should be looking at. So now this release is old. I could have sworn that these guys were going to announce today, October 21st. Chubb reports. So why don't they have their earnings announcement? Well, they probably have been. Nope, have been updated. So let me try to find the Chubb investor page. See if we can get their announcement. All right, so third quarter, here we go. Now we're talking. Okay, so now we're dealing with the most up-to-date information. Okay, so make this a little bigger for you guys. All right, so net income per share was up 22%. Okay. So these guys are really headquartered in Zurich, Switzerland. So their net income did go up nicely, 20%. Return on equity did go up to 15.9. Okay. All right. So premiums went up 7.5%. Combined ratio 81. So I think this is a very good ratio This means how much money are they making, combined ratio. You want this as low as possible, which shows your expenses are 81.8% of premiums. So these guys are making a fair amount of money from their insurance business. Very good. So that looks good. So 81%. Very good. So Chubb, make a few notes here. That looks good. So here's their balance sheet, and a balance sheet for an insurance company. This is all the premiums that are being paid to them. They're making money on those premiums. The reason the insurance business is lucrative is they get to make an interest on that money while they're holding premiums, and then they pay that out. So that makes sense. All right. So there's their income statement. So their financials look really good. So good earnings. I'm surprised that the market is not buying into their stock. It's up 18%, 0.18%, excuse me. Big difference in how I stated that. And their dividend isn't very high. Now, the one flaw of their overall, one of their metrics isn't very good. And that one is their return on equity is one of the worst ones. So when you look at insurance companies, this combined ratio is really important. These guys have 81, which is very good. And they're pretty close to being one of the best, but they're pretty close to being one of the worst, if not the worst, for return on equity. So that was one of their black marks. Out of insurance, I ranked them the sixth best insurance investment for me. Progressive's ahead of them. Number one is Allstate, and then Palomar being number two. So Chubb looked okay, but looks like it's not moving the needle, and the market is not impressed. All right, EQT. It was down a little bit today. Let's take a look at this one. This one here, EQT Corporation engages in the production, gathering, transmission of natural gas. Company sells natural gas liquids to marketers, utilities, industrial customers located in the Appalachian Basin. Okay. So these guys produce natural gas. Perfect. So data centers are going to need a lot of power, and that power could come from turbines that burn natural gas. So that's why I've become interested in these guys. I do like the idea of having a business where you're going to just sell the fuel for what is going to be a long-term need. These data centers are going to need power for a long time. So I like that idea. Now let's take a look at their earnings. I'd like to see what they had to report. Maybe there's some interesting details in their earnings announcement. So this is Q3 earnings announcement. Okay, cool. Let me open up their presentation. Okay. So these guys are headquartered in Pittsburgh, Pennsylvania. All right. Production sales volume of 634 BCFE. Okay. So they had CapEx. $484 million of free cash flow in the quarter. Okay. So their volumes did go up. The amount of natural gas they sold, price went up. It went up like 12 to 14%. Operating cash flow went up. Very good. CapEx went up. They put more money into the business. And free cash flow went up. It went from negative to positive. Very good. Okay. Okay. All right, let's take a look at their presentation, get familiar with this business. So operational execution. So this is where their operation is. Boom. So this is where the data centers are at. And these guys are providing natural gas into that region. Okay. So that's why I'm interested in this space. I own an oil company. It hasn't been doing all that great. This stock's done great. It's up like 300% over 3 years on this particular businesses. If you're going to produce, if data centers are going to be what the market's telling us, which are they're going to be massive and consume huge amounts of power, the quickest way to create power is through natural gas. And we have turbines. They're going to have to buy turbines, install the turbines, and produce the power. So that's how the power is going to get there. So I'm going to study this up on my own time, but looks like the stock is moving a little higher. I analyzed this stock and produced a video for members, and I put this stock in there. I really was aiming to get a natural gas play, and I think I found one, and I was able to pick up some shares and see a nice little rise. And we'll see if it continues to go higher. It's really been a winner for investors, and I could see it go higher. If natural gas prices go higher, there's no reason why this wouldn't go much higher. So we'll see where it goes. All right, so that's EQT. All right, so does Amazon own Twitch? They do. Yeah, they bought Twitch 5-10 years ago, way back in the day. All right, guys, so that was an excellent stream. We've gone about 2 hours and 8 minutes. So let's call it a night. What's going on with the market? So the Dow ended at an all-time high, by the way. The NASDAQ did lose a little bit of value. The Russell went down. Check to see if there's any headlines to report. Netflix is dropping a little bit. That's the only news that's out there. From a heat map perspective, we've got Amazon had a great day. Google, because of Atlas by OpenAI. The software space, look at that green, but we need that green to continue. These guys keep rallying up. It'll be a place to make some money, but you know, it's been a good week. Let's see if we can keep it going. We'll be watching it tomorrow. Be watching it for the next couple weeks. All right, perfect. So I think we're good there, guys. We're going to stream in the morning. We've got lots to talk about. So tonight we had some earnings, Netflix being the biggest one. And then tomorrow, before the market opens, so for the morning stream, we take a look at Thermo Fisher, AT&T, GE Vernova, Amphenol, Boston Scientific, CME Group. So there'll be Vertev is tomorrow before the market opens. And then Hilton. So there's lots of companies announcing. Then after the market closes, we're going to do a watch party starting at 4 p.m. Eastern. And we're going to really focus in on Tesla. But while we're at it, we're probably going to cover SAP, IBM, Lam Research, probably kind of catch up on anything we kind of missed in the morning. But it should be a fun afternoon if you want to spend it with us. It'd be great to have you. That's going to happen tomorrow. Osvaldo, the newest member of the community. You want to take a look at On Holding? It would be my pleasure, sir. Let's do it. So On Holding. On Holding AG engages in the development and distribution of sports products worldwide. The company offers an athletic footwear, apparel, accessories for high performance running, outdoor training, all day activities, tennis. It offers products through independent retailers and distributors. Yep. This is a new shoe. They're growing faster than Nike. Their design, they have these open air like tubes in the shoe, making them comfortable. I've never worn a pair, but I was out looking for sneaks the other day and I noticed them, and they're quite popular. A lot of people like them. Very comfortable, and people like running in them. People find them really, really comfortable. Looks like Roger Federer is an investor, I believe. So that looks good. All right. So these guys are kind of coming in after Hoka. Hoka, they've been really successful. They have really good, comfortable shoes that people like. These guys have come in and sold their shoes into a market that was maybe looking for something that was new, more comfortable. And I think this is one of the reasons why Nike is having so much trouble is you have On coming into the marketplace, and Hoka and other brands are coming in and filling in or taking market share away from the big guys being Nike, Adidas. And these guys are $14 billion market cap, revenue of $3.42 billion of revenue. PE is pretty high at 83. And then forward PE of 30.94. So these are a little expensive. Now, analysts are saying it's discounted by 47.68%. Year to date, selling off. I mean, it's a pretty good sell-off. 1 year, not looking good. It was working for a while, and then, man, it just stopped working. It has become a rough ride for investors. So let's keep looking. Now, we looked at Lululemon earlier. It'd be interesting to kind of see if they resemble each other. They're different forms of, consumer discretionary. These guys are consumer discretionary footwear and accessories. Lulu is consumer discretionary apparel, but they're kind of in the same kind of area of the wallet, so to speak. They're going after consumers, trying to get them to buy these premium shoes. These are not cheap. These are not the ones you're buying, at a discount and painting the house with them on. These are really premium shoes. Now, these guys are growing really well. Impressive growth, 35.67%. And you see that their revenue is getting a little chunky, 2.7 billion. Profit margin looks good. So we've got the free cash flow. Very good. Okay. Gross margins is 61%. This is a little better than Lululemon by like 200 basis points. Lululemon was like 59%. These guys are 61. And they are operating with a margin. They do have a little bit of profit, and they have a free cash flow margin, which is very good. All right, so 352. All right, let's take a look at their balance sheet. I don't want to see a bunch of debt. Let's take a look. So they have more cash than they do debt. Nicely done. They have about $500 million of cash in excess of debt. So that looks good. Okay. This will take care of itself when they get bigger. Forecast. 19 analysts are covering them. Some analysts are quite positive on this stock. $79 price target. Worst price target is at $40, which is not a lot of downside. That's why the consensus price targets are up at 48%. It's expected that they're going to keep growing. Okay. That's very good growth. They're going to end up being 5.68 billion. That looks good. Earnings per share looks good. Their profit's going to really grow. That looks really good. Very good. And then their PE is going to come down fast. All right. Fundamentals look great. Let's price this company and see where we think, or where I think, the intrinsic value ought to land. So I'm going to open up this website and have the information on another screen that you can't see. And then we'll come over here. Of course, the company we want to compare this to is Nike. This year, Nike is the place where capital goes to die. It just sits there. It gets tortured, not making any return for its investors. Not a pretty picture. So Deck is Deckers. These guys are the ones that own Hookah. They also have other brands that they sell. So I'll put them right down here. And we will take a look at this company. All right, so these guys are not in a very risky business, but apparel, I'm going to lower this to 8.5. Apparel is not a low risk category for me because there's just so much constant like competition. It's not like you're going to create a shoe and it's so great that nobody's ever going to want to, buy anything else. No, you're going to constantly have to create new designs and keep your customer. If you don't do that, your competition is going to come in and take your business, take your customers. So there's always a threat there. So I'm going to use a higher discount rate to recognize, hey, this is not a sit on your hands industry. Not that any one of them are, but some industries, they do have these barriers to keep competitors out. Like some pharmaceutical companies have really nice patents that keep the competition away. And these guys don't quite have that. They just really depend on their brand. So these guys are going to be growing mid-20s. So let's grow the revenue by 20%. And grow by 22%. All right. And they had a little more cash than debt. Let's take a look at that. All right. Let's take a look at their share count. So not much of a discount on cash. That's 2% discount, which isn't awesome. It's just fairly priced. Now let's take a look at their earnings per share valuation and see where that lands. So this coming year, I'm always looking 12 months ahead. And the earnings per share that's expected for the 2026 year is going to be $1.27. Say growth business, 18% is fine. Then they're going to grow really fast from there. So I'm going to go with 30%. And I can't get to the value of the stock. And the reason for it is I don't go very high with PE on consumer discretionary. You could use 24 if you really like the space. I'm still not getting there, but I'd rather just go with what I believe is 18. The cash flow isn't very high. So the distribution costs, marketing costs, it costs a lot of money to be a consumer packaged good company, a consumer discretionary company. It costs a lot of marketing dollars. So ON is actually priced too high. The market's showing that this business is not as valuable as, businesses like Reddit or Meta or Nvidia. Those businesses have high profits and they just crank out that free cash flow while growing. These guys are growing really well, but the market pretty much stopped appreciating this stock and now is in a point of, you know what? These footwear companies are not desirable because ON is down. Nike is a basket case. So here's ON, Nike, Deckers. 1 year, they're all doing bad. Deckers doing the worst. Nike doing bad. So the whole space, the market's like, yeah, it's not really desirable. And I have like a little theory about a lot of these products that we can easily understand because we're consumers. They tend to be priced a little too high because retail investors can understand them. They can tell a story about them. A wealth advisor could say, oh yeah, I got you into ON Systems. They make this shoe and it's very easy to illustrate to your client. Oh, that's a great idea. They're growing by 25%. I see people wearing the ON shoe everywhere. Okay, that's fine. But it's not about easy. It's about money. It's about who's making the most money. What industry is the most valuable based on the level of cash flow, profits, growth, balance sheets, that good stuff. And these guys are just not there. This whole industry is getting cooked. When we look at the 5-year, Deckers was the place to be. ON, not so much. Nike, that's where capital goes to get incinerated, destroyed, chopped up into little pieces. So Nike's been just a bad place to be. So that is ON. Thanks for asking. Hopefully you found the analysis interesting. We look at numbers. We look at numbers because it's easy to understand the ON holding story. It's easy to understand the product. That growth looks really impressive. But once we narrow it down and say, show me your cash. And I meant to show ON kind of alongside Lulu, right? Just so you see, like Lulu, I had a discount of like 28%. Lulu is $21 billion in market cap, $10.9 billion in revenue, and ON is $3.42 billion in revenue, almost about a third the size of Lulu, but the market cap is half of Lulu's market cap or more. Yeah, a little more. Now, Lulu is not growing like ON, but they're $11 billion. And you look at their cash flow rate, They're 1.168, where ON is like 365 million. So 1/3 the cash flow rate. So yeah, they are growing faster, but they just don't have a lot of value to them. So that's where I land on holding. And thanks for asking. Thanks for becoming a member. If you get a chance, shoot me an email. Love to get your contact information, give you a list of the perks that you get. I'm going to put my email in the chat, and you can just copy and paste it and shoot me an email. Thanks again for being a member. And there it is. All right. So, okay, good stuff. Thanks again, Osvaldo, Cartel Raider. Great to see you. And I think now we can call it a night. Thanks a lot, everybody, for joining me. Really nice to see some new names. Thanks for tuning in. Hopefully you found it interesting. Thank you to all you members. Man, more than 10, maybe 12, 14 of you showed up. Really appreciate the support. And I hope you got a lot out of this stream. Everybody, have a good night. Again, we're going to stream tomorrow morning. If you have time, tune in. If you're an afternoon, if you prefer to watch in the afternoon, we're going to stream again at the same time tomorrow to go over Tesla and a bunch of other companies. You can show up and request a stock as well on that stream. So if you want to make it tomorrow, it'd be great to have you. And that is it, folks. Have a terrific night. Thanks again for tuning in.